Stop. If the company you own shares in declares bankruptcy tomorrow, you get paid last. After the tax authorities, after the banks, after the bondholders, after the suppliers, and even after the janitor's salary. That's what equity really means. You own the residual claim. The leftover after everyone else is paid. I've spent 20 years in institutional banking, auditing thousands of portfolios. Retail investors bet millions on stocks, without understanding the one legal fact: they buy based on hype. Professionals buy based on cash flow math. In the next few minutes, I'll show you exactly how institutions price a residual claim, the 80-20 framework that keeps you safe to fail, and the tax trap that costs European investors 30% of their dividends, if they don't file one simple form. By the end, you won't just be buying a stock, you'll be pricing a legal claim on future wealth. Disclaimer: this is financial education and not investment advice. Let's start with the hard truth about the fine print of your investment. Why would a pension fund accept being last in line? It sounds like a terrible deal, but it's actually one of the most strategic positions in the market because of the asymmetry of the residual claim. Think about a bondholder. They have a priority, they get paid first, but their upside is kept. If the company invents technology that changes the world, the bondholder still only gets their fixed 4 or 5% interest. But as a shareholder, once the bills are paid, you own everything that's left over. You trade your priority for unlimited upside. But there's a second reason professionals love individual stocks: residual control rights. When you own an ETF, you're a passenger. You have no say in how the company is run. But when an institution owns an individual stock, they have a seat at the table. They use voting rights to steer how capital is spent, how much the CEO is paid, and whether the company should be sold. They aren't just investing, they are enforcing discipline to ensure that cash actually reaches the people who stand at the back of the line. You. Now, how do you actually price a claim that stands at the back of the line? You stop looking at earnings and start looking at the truth. In the retail world, the price-to-earnings ratio is the gold standard. But the professional auditor, the PE ratio is often a dangerous fiction. The E, the earnings, is an accounting construct. It can be manipulated by non-cash charges, depreciation rules, or one-time adjustments. We look at free cash flow yield. That is the cold, hard cash left in the bank, after the company has paid for maintenance or growth. This is the only money that can actually be paid out as dividends or used to buybacks. Here's the math for January 2026. The 10-year US Treasury yield, the risk-free rate, is currently at around 4%. That's your hurdle rate. If you invest in a stock with a 3% free cash flow yield, you're effectively paying the company to take your money, unless they can grow their cash at a staggering pace. Institutions look for a healthy equity risk premium, the extra return that demands for taking the risk of standing at the end of the capital structure. Around the start of 2026, the implied ERP in the US is roughly around 4.2%. This means your total expected return needs to be in the range of around 8% to justify equity versus safe government bonds. Price doesn't move because a company launches a new product. Price moves because of flow. Let me tell you what I mean. You need to understand mechanical liquidity. Large pension funds often have rigid mandates, for example a 60-40 split between stocks and bonds. If the market rallies 20%, their portfolio drifts to 65% equities. To stay within the strategic allocation bands, many of these investors must systemically take profits, regardless of how much they believe in the company. This is mechanical selling. It's the plumbing of the market, and it creates massive resistance at all-time highs. This is why we also track 30F filings and insider patterns. As we enter early 2026, the data shows clear tension. Insider selling in the tech sector is elevated, with CEOs like Jensen Huang and Jeff Bezos regularly selling large packages, turning billions in stocks into cash. When the people running the machine prefer cash over their own residual claim, you need to take notice. We look for cluster buying. When multiple insiders buy shares in the open market at the same time, that's one of the strongest signals that the residual claim is truly undervalued. So, should you even be picking individual stocks? Let's look at the math. Most professional investors fail to beat the market index after fees. This is why the foundational audit for your portfolio should start with the core satellite strategy. For example, an 80-20 split. The core, 80%, this is your foundation. It lives on low-cost passive ETFs. It captures the beta, the broad growth of the global economy. It's boring and it's safe to fail. The satellite, 20%. This is where you apply your institutional audit. This is where you hunt your alpha, the extra return above the market. Now, here's the truth that most financial influencers won't tell you. In the institutional world, individual stock picking often only becomes truly worthwhile once your liquid assets are in the range of around 1 million or way more. Below that, the time it takes to read 10Ks and calculate FCF yields often costs you more in life hours than a potential 1 or 2% outperformance is even worth. However, if you have a professional edge, if you work in a niche industry or understand a company's structural advantage better than the analyst in New York, then that 20% satellite is exactly where you express conviction. If you're going to play in the 20% satellite, you need a process. You need a stock delta 1 checklist. Before you ever click buy, run your target through 3 institutional filters. Filter 1. Structural advantage, the defensive barrier. We don't look at marketing slogans, we look at ROC, return on invested capital. Is the company generating a return on its capital that's consistently higher than its cost of capital? If not, every dollar of growth is actually destroying shareholder value. A company with a deep defensive barrier is a compounding machine. A company without one is just a capital incinerator. Filter 2. FCF yield is the free cash flow yield between 4 and 8%. If it's below 2%, you are paying a massive growth premium. If it's above 8%, you need a deep dive audit to ensure the business isn't facing structural decline. Filter 3. Capital allocation and correlation. What is the CEO doing with residual cash? Are they wasting on empire building through overpriced acquisitions, or are they doing buybacks when the stock is undervalued? In 2026, buybacks are often the more flexible and tax-efficient form of distribution compared to traditional dividends in many markets. And critically, does this stock actually diversify you? If your 80% core is already heavily weighted in US technology and you buy Nvidia or Microsoft in your satellite, you aren't diversifying, you're just doubling down on the same risk. Finally, we must audit the leakage, the hidden costs that eat your residual claim before it reaches your account. Geography is a hidden cost. US large caps offer deeper liquidity with roughly 4 times the average daily trading volume compared to European equity markets. This means tighter bid-ask spreads, the hidden fee you pay just to enter the market. But for European investors, there's a 30% tax trap. In the US, dividends are hit with a 30% withholding tax by default if you haven't filed a valid W-8BEN form with your broker. You're losing nearly a third of your dividend yield immediately. With tax treaties between the US and most European countries, that drops to around 15%, which can be credited against your domestic tax. Failing to manage this leakage is a guaranteed way to underperform the pros. Furthermore, there is an emerging risk international holding in hybrid structures. European and international tax authorities are tightening rules on cross-border entities, and poorly structured US vehicles can lead to a permanent tax leak in the medium term, if your structure isn't properly audited. Let me bring this all together. Equities are the most powerful precision tool for wealth creation, but only if you respect the residual nature of the claim. If you treat stocks like lottery ticket, the market will eventually audit your bank account. But if you treat them like a legal right to cash flow, you're finally playing the same game as the institutions. The 3 laws. 1. Understand the heartbeat. FCF yield plus ERP equals your real expected return. 2. Use a core satellite framework. Core for safety, satellite for conviction. 3. Audit the leakage. Tax forms and mechanical flows matter more than headlines. Now, if stocks provide the growth, bonds provide the floor. In our next episode, we step into the bond desk to decode fixed income, duration, credit spreads, and the trap of low coupons. I'm Philip, the audit of your stock portfolio is complete. Subscribe now, I'll see you in the next video.